Debt market update, April 2022. The 10-year benchmark GSEC surged during the month and ended at 7.14%, 30 basis points higher than the last month. The rise in yield was primarily driven by shift in pivot of MPC in April 2022 meeting to inflation from growth. RBI revised its forecast of average inflation for FY23 to 5.7% from 4.5%. Further, it stated that in the sequence of priority, inflation is likely to assume more importance than growth. GSEC yield movement was also impacted by persistent high inflation, rise in commodities, expectations of accelerated tightening by US Fed, and consequent rise in US yields, etc. Corporate bond spreads over GSEC narrowed on back of relatively weak supply. Average net interbank liquidity increased month on month and remained in ample surplus during the month on the back of government spending and robust growth in bank deposits vis-a-vis credit growth. FPI sold net debt worth $0.7 billion in April 2022, as against net outflows of $1.2 billion in March 2022. Cumulatively, FPIs have sold debt worth $1.8 billion in 4MCY22. In a more recent development, in an out-of-turn meeting concluded on 4th May 2022, the Monetary Policy Committee, MPC, hiked the policy repo rate by 40 basis points to 4.4%. It also decided to retain the accommodative stance, with focus on withdrawal of accommodation to ensure that inflation remains within the target going forward, while supporting growth. Further, it also raised the CRR by 50 basis points to 4.5%, which is likely to reduce banking system liquidity by approximately INR 87,000 crores. The urgency of the move surprised the market participants, and the bond yield surged between 25 basis points to 45 basis points, with higher rise at the short end. Outlook. While the action on policy rates was largely expected in the scheduled June 2022 MPC meeting, the urgency of policy action, especially on the eve of US FOMC meeting, along with hike in CRR, stumped the market participants. In its statement, RBI Governor also highlighted that it is only part reversal of the total repo rate cut of 115 basis points which MPC did post the outbreak of pandemic. RBI appeared increasingly concerned on inflationary pressure intensifying, but is relatively comfortable with the growth trajectory. Going forward, the volatility in the fixed income market is likely to remain at heightened levels in the near term as the market adjusts to the surprising shift and urgency in RBI's policy. This is likely to lift yields higher. In addition, elevated commodity and energy prices, large government borrowing program, resilient CPI and WPI, high SLR holding of banks, accelerated tightening by major global central banks, etc., are also likely to put further upward pressure on yields. The chances of lower fiscal deficit appear dim too, as the government outgo on food and fertilizers subsidy might exceed the gain expected due to higher tax collections. Thus, in the short term, most factors appear stacked up against yields. However, these factors have been prevailing for some time now, and the impact has been priced in, to a certain extent, in the current yield levels, considering 10-year yields have increased by approximately 90 basis points in the current calendar year. Further, hike in CRR and expected widening of CAD and consequently negative balance of payment in FY23 is likely to lower aggregate system liquidity over time, and thus could open up space for conducting OMO purchases by RBI in the second half of the year. On an overall basis, in our view, yields are likely to trade with an upward bias in the near term. Further, policy normalization is also likely to put upward pressure on yields, especially at the short end. In view of the heightened near-term volatility and expectations of continued flattening in the yield curve, we recommend investments into short-duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.